Okay, so as I said, we have to estimate what our overhead's going to be before it actually takes place most of the time so that we can build that into our job. So we have a three-step process here. The first thing we do before the year even begins, we come up with a predetermined overhead rate, okay? And I usually just write that predetermined overhead rate like that. Then once we come up with that rate, and I'll show you how we do that, as we go throughout the year, we'll allocate that to the jobs based on that predetermined overhead rate. And then at the same time that's happening, we're also calculating the actual overhead as we pay the bills and, buy the materials and pay the janitor and all those types of things. And then we go ahead at the end and we compare what we actually allocated to the jobs versus what our actual was, and we adjust for the difference. So that's the process we're going to go through now. So the first step in that is to calculate that predetermined overhead rate. So for this you need predetermined overhead rate. So for this you need a cost driver. And this is, again, accountants very clever with their names. The cost driver should be the thing that's driving your costs, okay? So most of the time in here we'll use direct labor hours, or maybe direct labor dollars, like the dollar amount instead of the hours, or machine hours. So the number of hours your machine time is running, like if it's a manufacturing type of thing. So those would be the three main things, the main drivers that we'll use in this book. You get into some other ones that can get a lot more complicated, but for now we'll just stick with those three. So at the beginning of the year, you take your estimated actual overhead dollars, what you think your total manufacturing overhead cost is going to be, and then you divide that by the estimated volume or quantity of whatever your cost driver is. So for instance, let's say you think you're going to have $10,000 in total overhead, and you're using machine hours, and you think you're going to have 4,000 machine hours throughout the year. So then you would come up with a rate of $250 per machine hour. That's your predetermined overhead rate. So for every job, every hour it spends on the machines, you're going to add $250 in overhead. That's how it works. So when we apply it, we would take the actual quantity of the cost driver. So let's say this job incurred 300 machine hours. You would take that times your predetermined overhead rate, which in this case we said was $250, and that would give us our allocated overhead. And in this case, that would be $750. So I'm going to add $750 in overhead to this job. And again, when I'm allocating it, I'm going to be crediting manufacturing overhead. Before, when I was doing the actual overhead, I was debiting it. Now that I'm allocating it, I'm going to be crediting manufacturing overhead. So I would debit work in process, and I would credit manufacturing overhead for $750. And so what goes into the job, so when we look at our job cost record here, what goes into the job is the allocated or the applied. I kind of say allocated and applied interchangeably. They're really the same. So this is what goes on the job cost record. What goes into work in process is the applied. That's what goes into your work in process, not the actual. So in this case, these people were using 40% of direct labor dollars. So you can see they added up the total materials here. They added up the total labor here. And then they took that labor times 40%, and that's what they put into manufacturing overhead. So you add the three together, you get 4,500 divided by 15 tablets, and so that ends up giving you $300 per tablet is their cost. So let's do a couple of these where we're going to do some actual and some applied overhead things. So Oak Outdoor Furniture manufactures wood patio furniture. If they report the following costs for June, what is the balance in manufacturing overhead before overhead is applied to the job? So that means this one, they want the actual. Now, in this book a lot, I feel like they act like they just wait to the end of the year and then apply all the overhead, but it would really kind of go by jobs, like we see in this one. So as the job, they're just going to keep adding overhead to each job, and then by the end of the year, you would have a bunch there. Okay, so we're going to say the labor has been incurred but not paid yet, so that means that's going to be wages payable. So first of all, we just want the overhead, right? And so the wood would be direct materials, so we don't want that. This would be indirect materials, the nail, glue, and stains. We want that one. Depreciation, we want that one, because that'll be manufacturing overhead. Indirect manufacturing labor, so that's our indirect materials. Depreciation on the delivery truck, that would be selling and administrative, so we don't want that one. And assembly line workers would be direct labor. So again, we don't want that because that would be not part of overhead. So that means we need to record these three things right here. So because these are actual, these are all going to be debits to manufacturing overhead. So for the first one, I'm going to debit manufacturing overhead for $18,000. And for indirect materials, I'm going to be crediting raw materials inventory for $18,000. Then depreciation on the saws, I'm going to debit manufacturing overhead for $5,300, and the credit would be accumulated depreciation. Accumulated depreciation, $5,300, and then I'm gonna, for the indirect labor, debit manufacturing overhead and credit wages payable for $45,000. And so that'll take care of that. So that's what it looks like for my actual overhead. Again, for actuals, the debit's always going to be manufacturing overhead. The credit would be whatever it would have been if you were recording these expenses before, if that makes sense. Okay, so here's another one, job 303. We have, here's the direct materials, here's the direct labor, and they allocate overhead at a rate of 40% per direct labor. So somebody already calculated the predetermined overhead rate for us. So what's the total job? So the direct materials are $550. The direct labor is $400. And if and so just to remember, so for the direct materials, we would have debited work in process and we would have credited raw materials. It's not asking for the journal entries here, but what the heck, right? Here we would have debited work in process and credited wages payable. And then the overhead is going to be 40% of the 400. So 400 times 40% or 0.4 gives us 160. And so that's what's gonna be in the manufacturing overhead. And again, this one, debit work in process, credit manufacturing overhead, because this is the applied one, okay? And so you can see all three of these things. This is what's going into work in process. So the total is 1,110. But again, what we have right here is basically what's on that job cost record. The total materials, the total labor, and the applied overhead. And so everything's going into work in process. So the job cost record is everything that's going into work in process. And let's see. Here is the Roscoe company estimating that they will have, okay, so now we're going to come up with a predetermined overhead rate and then allocate it to the job. So this is what they're estimating their overhead costs are going to be. They're using direct labor hours, and this is how many they're anticipating, 4,750. So let's do the predetermined overhead rate first. Predetermined overhead rate. So again, we take the estimated overhead in dollars over the estimated cost driver, which in this case is direct labor hours. So they're anticipating 80,750 divided by 4750 direct labor hours. So I come up with a rate of $17 per direct labor hour, okay? When I allocate the jobs, I'm going to use the actual direct labor. They actually incurred 4,600 direct labor hours. So when I allocate this to the job, 4,600 hours times my predetermined overhead rate of 17, which is that guy, equals 78,200 is the amount that I actually apply to the jobs. And so work in process inventory is where that's going. And then it's a credit to manufacturing overhead, 78,200. And again, this one they're looking like they did the whole thing all at one point at the end of the year, but really that would be happening every time you finished a job. You would be adding the overhead based on the number of direct labor hours spent on that job. So then you can see at some point then we have to say, well, here's how much we added to the jobs, but what was it actually, because we have to make sure we're putting the right amount in there. So at the end of the year, more than likely you're going to be over or under applied. If you remember, when we did the actual overhead, we were debiting manufacturing overhead, and when we were applying it, we were crediting manufacturing overhead. So why might the actual not equal the applied? And it really, it's one of two things. You could have more or less of the cost driver than you were anticipating. So remember that predetermined overhead rate was the amount of overhead and the amount of the cost driver. So if either one of those is off, you're not going to apply as much as, you're not going to apply the right amount. So you could have more or less of the cost driver, or you could have more or less of the actual overhead. So if some of those costs were more or less than you were anticipating, or if you had more or fewer of the actual cost driver than you anticipated. But at the end of the year or the quarter where you're doing, remember the actual is a debit. So every time I incurred an actual, those would be over here on the debit side. And then when I applied it, it comes over here on the credit side. So basically, if you end up with a debit balance, that means your actual overhead is greater than your applied. And so you are under applied. You didn't build enough into your jobs. And then if you end up with a credit balance in manufacturing overhead, that means your applied is greater than your actual, so you are over applied. And they are actually both problems. If you're under applied, you didn't build enough into your job, so then the price you used to charge your customers, you thought you were covering your costs and you're not, or you thought you were covering your costs and getting a certain profit, and really your cost, you didn't put in enough for that, so your profit's something less than what you thought. If you over applied, then you're probably overcharging your customers, and if you're in any kind of competitive industry, then that's going to be a problem. So either way, you're not, the number that you used, because remember, whatever goes into work in process then gets transferred into finished goods, which then gets transferred into cost of goods sold. So if you're not putting the right amount into work in process, the amount of cost of goods sold is going to be off. So we have to correct for that. So in this one, we have the following information. What is the actual? So the actual is over here on the debit side. So if you add those three up right there, you get 57,000. So that's your actual. And what is the allocated? That's over here on your applied. So that's 5,600 is how much you allocated to the jobs. So allocated and actual. on this side. So your actual is greater than your allocated. And so you are under allocated. You didn't put enough in there by, what's that, 6,400. And that's the difference between the two. So if you were to foot this, you'd have a 6,400 credit or debit balance over here. And then here's another T account. Again, this would be our actual on the debit side, and this would be our allocated over here on the credit side. So actual is 195 and allocated is 203. So in this case, I'm over by the difference, which is $8,000. Okay. So I think that's a good place to stop this one. We'll kind of come back and we're going to finish off the whole process, and then we're going to adjust for our over or under allocated, and then have one to look at for service businesses.